This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, May 11th, 2016. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers' report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals. In the intermediate term, risk, and the short term, confidence and sentiment. This month, I'd like to cover a range of topics shown here. I'd like to talk about what I see as a market structure approach and a trend pattern and where we're positioned in it. I'd like to show and discuss what I see as investors exiting the party, the market, and the degree that I'm seeing that. The misplaced and false beliefs that are supporting this market and where the exposure is, the Achilles heel associated with that, and an update that ties it together in what I've talked about previously, the Shanghai Accord. This graphic explains the four important phases of market trends based on the methodology of the famous stock market authority, Richard Wyckoff. The theory is that basically the better an investor can identify market phases within the market cycle, the more profits can be made on the ride upwards of a given buying opportunity. I won't take you through the details, but what I wanted to show is a number of comparisons in previous cycles. We can see that through the 11-year era of the Federal Reserve Chairman Alan Greenspan's irrational exuberance, these phases played out as Wyckoff would have expected, almost perfectly and mirroring his basic structured phase approach. We once again see that during the run-up to the financial crisis that we experienced a similar pattern during a 6-year period from 2003 through to 2009, maybe a little more dramatic in terms of the decline. So what do we see now? We see the first three phases of accumulation, markup, and distribution seeming to have again occurred. Rather ominous, isn't it? But of course, we all know it is different this time. The global central bankers are on the job and they just won't allow the decline stage to occur because this time it's different. If we look a little closer, since the Chinese shocked the world in August of 2015 with a devaluation threat of the yuan, we have a very similar pattern playing out as we talk right now. Surely this isn't going to play out again. But then on May 2nd, just a few weeks ago, the Chinese once again weakened the yuan. Can we again expect more from the Chinese? We will discuss this possibility in more detail a little later when we talk about the cracks appearing in the Shanghai Accord. We talked about the Shanghai Accord, as you'll recall, in previous reports. I do get concerned when I read of Carl Icahn shorting the markets at unprecedented levels, and Bloomberg putting out analysis like the one shown here. Obviously, all of this correlated data is suggesting a contrarian move is ahead. Surely the central banks will see this and are loading their bazookas to stop a market swoon from occurring. But are the potential underlying market factors actually bigger than the central bankers may be able to handle? This chart shows a composite of the key global markets set to 1 on December 31st, 2014. As a technician, there's a pretty clear channel to be seen with support and resistance levels in play here. It suggests that between now and the U.S. elections, the global market may be in for a very rocky period. It looks like the classic sell in May and go away mantra that Wall Street has used for years. Even conservative people like John Malden, I read here today, are saying exactly this. Is it possible that global pressures will be too complex and overwhelming this time for the central bankers and central planners to actually control? Time will obviously tell, but certainly caution is well advised at this period of time. One thing we don't need to speculate on is the fact that indications are that investors no longer trust the financial markets and have been exiting, and exiting significantly, as can be seen here from Bank of America Merrill Lynch reports of their customer set. The only thing that has been holding up the markets has been historic and unprecedented levels of corporate stock buybacks and dividends, funded by debt, not earnings. And we'll talk more about this in a moment. Let's consider some of the factors that Bloomberg's research recently published which illustrated investors no longer trust the markets. First, investors are seeking safety. 4 of the 5 most popular exchange-traded funds this year are ones purported to offer less risky investments than the stock market at large, according to data compiled by Bloomberg. Among them is the iShares MSCI Minimum Volatility ETF, which has garnered $4.7 billion in cash, more than any other fund. That compares with its 3-year total flow of $7.6 billion. And the buyers are going missing. The only type of investor buying stocks this year has been, as I said, companies that issued them, according to the Bank of America. The bank's institutional, private, and hedge funds clients were net sellers of equities in the week ending last week. On average, those clients have sold a total of $1.7 billion in stocks the past 4 weeks. Short sellers are digging in their heels. The rebound in the S&P 500 hasn't done much to shake short sellers of their conviction. Even after wavering in March, the average short interest as a percent of shares outstanding in U.S. stocks is at 4.1%, higher than at the start of the year and at one of the highest levels in the bull market. Mutual funds are generally in a mess. It doesn't seem investors have regained faith in active managers since the start of the year erased $3 trillion in equity value. They've pulled money out of the mutual funds for at least 8 straight weeks, according to Investment Company Institute. Can you blame them? The VIX is a losing bet. It's not hard to see why investors in the first 2 months of the year developed an affinity for ETFs that pay off when volatility increases. Why they've continued to add money to the funds as the S&P 500 slipped into its quietest period of the year is a bit more puzzling. Still, shares outstanding in one security, the Velocity Shares Daily 2 times VIX Short-Term ETN, remain at an all-time high. We're paying for defense. Investors started buying defensive industries at the beginning of the year and haven't looked back. The price-earnings ratios of the consumer staples, utilities, and telecom stocks have risen faster in the past 6 months than any other group in the index apart from energy and material shares, whose valuations have risen amid a drop in earnings. Bank of America says that Wall Street doesn't believe in this rally, and that's a quote. It is certainly a first when even the sell-side community on Wall Street doesn't trust the markets. I don't ever recall this. Or is it that they believe the central banks don't have the tools to stop a global slowdown? That may be really what they're saying. We have talked extensively about the magnitude of the slowdown in global trade. Whether we look at global shipping, air freight, railroad traffic, trucking traffic, the story's all the same. Plummeting volumes that are worse than even during the financial crisis. Thank goodness the central bankers are on the job. However, the recent press conferences of the Bank of Japan, the European Central Bank, and Federal Reserve left everyone clearly confused as to what they are possibly thinking, or whether we are witnessing a modern-day version of the Keystone Cops playing out in front of our eyes. We are witnessing a cracking foundation in the credibility of the omnipotent central bankers. Are the beliefs we have false? Major market drawdowns are almost always based on the realization that investors have adopted mistaken beliefs, beliefs which are suddenly corrected, often in a shocking manner. For example, central banks' policies will continue to support the markets at these levels. 2, corporate stock buybacks will continue. 3, there is no global nor U.S. recession in sight. 4, the bull market is still cheap on a relative basis. And there are more. But if any of these foundations were to be like a rug pulled out from under us, the market and the drawdowns would happen. And all of these ones I've listed here are certainly in question, and we've talked about these also in the past. Over the past 15 weeks, as I've said, the Bank of America Merrill Lynch has documented one of the more curious indicators hinting that at least the smart money, that is the hedge funds, institutions, and private clients, have refused to jump on board the market rally as a result of what is now a record 17 consecutive weeks of selling in the market rally as per the Bank of America client data. Now, according to the same Bank of America, there is another sign that Wall Street doesn't believe in the rally. This is what the Bank of America equity and quant strategist in charge has to say. And I quote, "In April, the sell-side indicator, our measure of Wall Street's bullishness on stocks, fell by 1 percentage point to 51.9, its lowest level in over a year. This was the indicator's biggest one-month drop in the past 2 years as the S&P 500 rallied 15% from the February lows through mid-April. This triggered a contrarian buy signal in the model for the first time since January. While sentiment has improved significantly off of the 2012 bottom, today's sentiment levels are still below where they were at the market lows of March 2009. Strategists are still recommending that investors significantly underweight equities at 53% versus a traditional long-term average benchmark weighting of 60 to 65%. To be sure, since Bank of America makes far more money when the market rises and when clients buy rather than sell, this was the spin. To the Bank of America, the pervasive bearishness is a reliable contrarian indicator. The sell-side indicator is based on the average recommended equity allocation of Wall Street strategists as of the last business day of each month. We have found that the Wall Street's consensus equity allocation has been a reliable contrarian indicator. In other words, it has historically been a bullish signal when Wall Street was extremely bearish and vice versa. Then again, now that everyone, even Goldman Sachs, agrees that the marginal, if not only buyer of equities is corporate buybacks, shouldn't Bank of America's survey focus more on how much of their own stock corporate treasurers plan on buying back and just how bullish they are on their own equity-linked compensation, funded generously courtesy of yield-starved, investment-grade, and in some cases high-yield investors who don't care what the use of funds is as long as they hit their bogey of outperforming treasuries for the next few months until the 2016 bonus is paid? As for whether the extreme bearishness this time is bullish for stocks or merely an indication of just how stretched the central banks are in their attempt to prop up markets, buybacks, and overall investor sentiment, we expect to have the answers in very short notice. I've come to the conclusion that there are two headwinds which are going to soon significantly impact the financial markets and specifically the equity markets. The first trend is falling EBITDA and cash flow and rising net debt. This means a credit deterioration. This is what triggers credit analysts to lower credit ratings, is when cash flow starts to fall off in relationship to total debt, and especially if that debt's growing. The debt therefore becomes more expensive and there's more restrictive covenants on the money to be able to get it. That's the process that we're in. And therefore, buybacks are only a matter of time before they're going to start to slow, and it's probably a first derivative kind of problem. The second trend, and maybe even more alarming if it could be, is increasing hedge fund redemptions from insurance and pension funds. That is, hedge funds in many cases are folding, but redemptions are coming to them because of bad performance, lack of performance from major insurance and pension funds who are pulling out of hedge funds. And hedge funds are traditionally invested in financial markets, that is, exchange-traded markets. And the insurance and pension funds are talking about putting this money into private placements. The private placements are not exchange-traded funds. This is called liquidity pull from the financial markets. Now, if the numbers were small, maybe we'd not pay attention. But if you look at some examples here, just in the last few weeks that I've noticed, we're seeing AIG withdraw $4 billion from its hedge fund investments. We've seen the largest life insurance company in America, MetLife, redeem between 1.2 and 1.8 billion in its holdings. Now these are over a period of time, and you can see the list here of just the ones I quickly identified. All in all, it's not a very pretty picture, but it's a trend, and it's a trend that I don't see reversing. I actually see accelerating. And I've done tapes at Financial Repression Authority with Amin Rajan, who was contracted to survey 186 pension plans in Europe. And the report is up on the Financial Repression Authority website. But what he found was that the pension plans, who are now under tremendous pressures, are no longer able to buy long and stay long with their positions for extended period of time, because they were able to do that by hedging strategy. So no matter what happened to the stock, there was gains on it if they were properly hedged. Because the markets are now so correlated, they can't find hedges. Therefore, their strategies are not working. That's also, I think, what reflects here with these withdrawals and redemptions, is this lack of ability to hedge. And so they, in Europe, are also moving to private placements, according to Amin Rajan's findings. So I think this is a major shift and a major trend. It doesn't signal good things for overvalued global equity markets. But let's revisit developments for a second, if we could, in the Shanghai Accord, which we've talked about, and see if we can just tie some of these things that we've been talking about together in some sort of roadmap. As a recap, we've had significant releases from the central banks since we last reported on this subject. Have they supported our conjecture that there was in fact an accord struck at the February G20 meeting in Shanghai, China? I believe this timeline shown here and the announcements made are very telling. The orchestrated timeline suggests that it is time for the ECB to make a startling announcement, and so we should watch what happens on May 12th after this report is out, as you can see kind of at the bottom of the chart of where this is signaling. But every one of these dates actually stunned the market. It shocked the market. It wasn't what they were expecting, and it drove currencies in the suggested pattern that we were expecting when we were talking about the Shanghai Accord. Well, let's look at some of those patterns. Since the suspected Shanghai Accord was struck, the euro has steadily increased in US dollar terms. Nobody expected that. You can see that the spikes higher typically corresponded to the ECB statements that I had just shown previously in the grid, and some of the other spikes correlate to some of the other central bank announcements. Similarly with the Japanese yen. The yen has risen in US dollar terms, dragging the US dollar JPY cross lower. Here is the US dollar, which has correspondingly weakened as the yen and euro increased in value and also made moves lower associated specifically with Federal Reserve announcements. Though on the surface the plan appears to be working, on May 2nd the Chinese still weakened the yuan on their own. We suspect they gave the other members of what I've referred to as the currency cartel until May to see results, or are expecting retracements to give back some of the gains which the Chinese are dearth to allow as their economy sinks deeper into the trouble. It's one or the other. But certainly the Chinese feel they're running out of runway and out of time here. All of these activities are resulting in weakening carry trades. This is important. Weakening carry trades, which is reducing global liquidity, as well as are acting as destabilizing factors. With commodities recently showing strength, particularly food-related commodities in China, it could produce some of the inflation the debt-laden economies are so desperately trying to achieve. The potential could impact bond yields, and soon. And we could see a spike up in yields, drop in bond prices, collateral issues, financing issues. The bottom line is we might see equity markets starting to weaken by early summer if you follow the sequence here from left to right, and the charts are bearing that out. Don't underestimate in any way the importance of the carry trade. The U.S. carry trade is responsible for between 7 and 9 trillion of debt to emerging markets since the financial crisis, which has been under severe pressure associated with the strengthening U.S. dollar. The Achilles heel of the carry trade is a strengthening currency in which the carry trade is financed. The Japanese carry trade has a rising yen. Bad news. The euro carry trade, a rising euro. Bad news. US dollars weakening, which has helped countries who are under tremendous pressure with that $7 to $9 trillion I just mentioned. We showed this graphic last month, and our analysis today further strengthens this real roadmap possibility, this first down leg that's coming sometime in 2016, and maps to things that Martin Armstrong has talked about. This is his economic confidence model shown, and our Shanghai Accord labeled across the top, and other players have also talked about that have similar economic models. Of course, I'm talking about Harry Dent and his projections of the amount of deflation that he sees coming and his various cycles, which I have tapes on file at the Financial Repression Authority outlining his views. I showed this chart earlier in the slide set, but a number of points now need to be mentioned. The S&P has repeated a pattern over the past year in which the index peaked, drifted lower for several weeks, and then sold off sharply. Currently, the S&P remains on track to repeat the pattern again. Such a development suggests a short-term rally through the end of May, a drift lower, then a sharp correction in late June or July. These developments would align with the index rallying to recoup most of the decline since late April, and then consolidating in the weeks before a significant event risk from the Fed meeting on June the 5th, the Brexit vote on June 23rd, and the Spanish vote on June 26th. The final market development, should the patterns of the past year repeat, would be a sharp sell-off consistent with some type of negative shock from one or more of these events or others. It is my opinion that the credit cycle, as I've said numerous times, has now turned. And additionally, the business cycle is also now turning. These are certainly serious headwinds for the global central bankers to overcome. But never fear. You can always count on the government to print more money the moment the opportunity presents itself. That time may be soon and once again close at hand. As I said earlier, do not trade from any of these slides. These are not investment recommendations, but rather these are guideposts that I think you should watch closely to see whether some of this speculation that we're laying out here that we think is well-founded and well looked at is actually correct. But do your own research and study it very, very closely and watch very closely. Listen to the announcements. Some of these patterns are very, very telling, and it's unusual for so many of them to line up so closely and so clearly. So watch closely, pay particular attention, and remember to reduce risk.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.